I did not grow up chasing the next shiny thing. I spent my adult life watching money move. I study policy papers. I read balance sheets. I watch trends slowly turn into new rules. Today, on November 19th, 2025, Bitcoin is suddenly back at the center of the story. We are looking toward 2026. And why you, someone who keeps an eye on bills, the grocery list should pay close attention. It is not about hype. It is not about getting rich quick. This is about a quiet but powerful shift happening right under our feet. For years, Bitcoin was loud, screaming headlines, screens of young, hopeful traders. Then the noise settled. People started calling it a niche bet, a digital oddity for the tech-savvy. But now, things look different. The main engines of our economy are changing course. The change is small right now, almost invisible if you are not looking for it. Small changes in the world of money can become very big, very fast. Something is happening, and it deserves a calm look. Let's start with the choices governments are making. This is where the story truly begins. For more than a decade, especially since the early 2020s, managing enormous national debts trying to control rising prices, inflation. By 2026, many of the plans they put in place are reaching a critical point. Central banks are now caught in a very tight spot. They face a difficult choice that affects every single one of us in our daily lives. They can either continue to raise interest rates and take other measures to fight inflation, which risks slowing down the economy and potentially causing job losses. Or they can ease up on those policies to keep the economy growing, which risks letting inflation climb higher and eating away at the value of our savings. Neither choice is good. Both options have serious costs. This difficult reality is forcing people who run countries to look for tools and solutions they might not have considered just a few years ago. It has opened the door to new conversations about the nature of money itself. This is why you are hearing officials talk more about digital assets in public forums. They are not endorsing Bitcoin. Let me be very clear about that. Instead, they are exploring the idea of their own digital currencies. Next, we need to look at who is buying Bitcoin now. This is a very different picture from what we saw 5 or 10 years ago. For a long time, Bitcoin was owned mostly by individuals, tech enthusiasts, early believers, speculative traders. But as we head into 2026, the biggest players in the financial world have begun to enter the market in a much more visible and significant way. I am talking about large institutions, pension funds that manage retirement savings for millions, public companies listed on the stock market, some of the big conservative banks. Why are they doing this now? Their reasons are simple and pragmatic. These are not emotional decisions. Some see Bitcoin as a potential hedge, insurance against currencies losing purchasing power from inflation. Others view it as a new asset class, different from stocks or bonds, to diversify large portfolios. For them, it's a calculated move to protect and grow large pools of money in an uncertain world. When large, trusted institutions start buying, it sends a powerful signal to everyone. Their involvement can change both price and perception. Because they buy in such large quantities, their actions can help stabilize prices and reduce wild swings. More importantly, their participation brings a new level of legitimacy. It signals that Bitcoin is being taken seriously as a store of value by pillars of the financial system. We are not there yet, but the trend is clear. For you, this matters immensely, even if you never buy a single fraction of a Bitcoin. The third major shift is the arrival of clear rules. For many years, the world of digital assets felt like the Wild West. The regulations were confusing, inconsistent, or in many places, non-existent. This created a lot of uncertainty and risk for everyone involved. But the landscape in 2026 looks dramatically different. Many of the world's major economies have finally put concrete laws in place to govern digital assets. These rules are creating clear boundaries and making the market much more structured. These new regulations cover a lot of ground. They establish clear requirements for cryptocurrency exchanges on how to operate, how to protect customer funds, how to report their activities to the government. They set strict rules to combat money laundering, fraud, which helps to clean up the industry's reputation. Now let's talk about the fourth element, which is quieter but potentially the most powerful. There are growing whispers among serious financial analysts about a gradual shift in the global currency system. For decades, the US dollar has been the world's primary reserve currency. Other countries hold dollars to conduct international trade and to manage their own economies. Some experts are now suggesting that this dominance may slowly begin to fade. This does not mean the dollar is going to collapse overnight. That is not what this is about. Instead, it points to a slow, multi-year adjustment in the balance of global economic power. We could be moving toward a world where several currencies share the role that the dollar has largely held alone. This could happen as trade agreements are renegotiated, or as major economies seek to reduce dependence on a single currency for global commerce. If this shift happens, even slowly, it will have a profound impact on how countries and individuals think about savings debt, the value of the money they hold in their hands. Why should this matter to you, an everyday saver? Because the value of global currencies touches everything in our lives, often in ways we do not see. It affects the price of the coffee you buy, which might be imported from another country. You might be listening to all of this and thinking, "This is interesting, but I don't own any Bitcoin, and I don't plan to." That is perfectly fine. My goal here is not to convince you to buy anything. It is to equip you to understand the world around you. These changes can affect your finances even if you don't participate directly. The ripples can touch the value of your home, the stability of your job, and the long-term security of your retirement accounts. So what should a practical person watch for? I will give you 4 simple signals to follow. You don't need to be an expert to track them. First, watch for official statements from central banks about inflation and debt. Listen for a finance minister speaking. Listen for a central bank governor speaking. Watch for announcements about interest rate changes. Watch for government borrowing level announcements. These are levers that move the economy and can push people toward alternative assets. Second, keep an eye on the quarterly reports from major institutions. Watch for announcements from a large pension fund. Watch for announcements from an insurance company. You can often find this information in public filings or in the business section of the news. I promised you a point that most people miss. Here it is. The biggest, most important change happening in 2026 is not the daily price of Bitcoin. It is not the latest headline. It is not the prediction of some analyst on television. The real story is the quiet, gradual migration of trust. Trust is the invisible glue that holds our entire financial system together. We trust that the money in our bank is safe. We trust that its value will be relatively stable tomorrow. We trust the institutions that manage our pensions. We trust our laws. When that trust begins to shift, even slightly, everything else starts to move with it. What we are seeing is a subtle but undeniable transfer of trust from some traditional systems to new ones. It is not a complete abandonment. It is a diversification of trust. People and institutions are not giving up on banks and governments, but they are starting to place a small amount of their trust in a parallel system, one that is built on mathematics and code, instead of policy meetings and political promises. This is the part many people overlook. They get caught up in the drama of the price charts. They watch the numbers go up and down, and think that is the whole story. So, what can you do now? How do you prepare for a future that feels so uncertain? The most important thing is to act from a place of knowledge, not fear. First, take the time to learn the signals I mentioned earlier. You don't need to be an expert overnight. Just start paying attention. Knowledge is your first and best line of defense. Second, review your financial foundation. Build an emergency fund, 3 to 6 months in an accessible savings account. This is your buffer against unexpected shocks. Third, remember the power of diversification. Don't put all your savings into a single asset. Real estate, stocks, alternative assets, art, commodities, crypto. A well-balanced portfolio is designed to weather different economic seasons. Fourth, find one or two reliable sources for your financial news and stick with them. Look for sources that explain things clearly, without hype. Stay informed, not scared. Follow this channel for grounded updates to help regular people make smart money decisions in a changing economy.